We're really glad to have you all here today. And we're very, very pleased in particular because Bill White has been able to come over and give us the benefit of his international experience. He's a former Chief Economist to the Bank for International Settlements, the sort of bank for central banks around the world. He's also been a Deputy Governor for the Bank of Canada. And now he's semi-retired and spends his time dotting around the world, basically giving his advice. Previously having been known for disagreeing with Alan Greenspan, and being one of the few people who actually sort of saw the financial crisis and the roots of it coming, sort of grew uneasy with all the irrational exuberance that Alan Greenspan talked about. And after a long period where people weren't listening, I think now that these certain issues have happened, finally Bill's getting the chance to really expound on these views, and people are going to make the right changes. But you're not here to listen to me, you're here to listen to Bill. So without further ado, Bill?
Let me be very clear, the only reason I was against the irrational exuberance was because I wasn't making any money out of it. I want to really sort of ask a question or two questions. Is price stability enough? We got countries all over the world, I'll talk a little bit about that, countries all over the world now that are inflation targets, some explicit, some implicit. Or do we need a new framework to do things differently? And I guess at this particular juncture in the United Kingdom, this is probably a good time to be talking about this range of territory. But let me start off with a little epistemology, because I'm very conscious of the fact that you can stand up here and sort of say, well, there's a better way to do it. But behind it all, I think we have to have a very clear understanding of how little we know with respect to a lot of stuff. And you may remember this line from Don Rumsfeld, which when it first came out, everybody said the man's an idiot. And then they thought about it a second, and then they said, well, at least in this regard, he's a genius. There are known knowns, there are unknown unknowns. But there are known knowns, there are known unknowns, but there are also unknown unknowns. And Mark Twain, I mean, this is like type 1 and type 2 error. Mark Twain, I thought, had an even better line. He says, it ain't the things that you don't know what get you. It's the things what you know for sure, what ain't so. Got a lot of that, and I want to talk to that. And this line, I think, is wonderful. It was something that Keynes wrote in 1930. Today we have involved ourselves in a colossal muddle, having blundered in the control of a delicate machine, the workings of which we do not understand. And I think we should keep this in the back of our minds here, that there's a lot of stuff still that we don't really understand. Let me talk about inflation targeting and its successes and its failures, and why this leads us on to the general question of whether we need something to replace the way in which we've been doing things. In the 1970s, and I mean, I worked with Jeff Wood here actually at the Bank of England in the latter part of the 1960s and the early 70s at the Bank of Canada. And of course, inflation was a huge problem. And we could see almost on a daily basis the kind of difficulties that it was causing: redistribution of income, absence of information in the price system, the constant fear that what was going up would continue to go up, that there was no sort of just living with this beast. It either had to be tamed or you had to get rid of it. And Paul Volcker, basically, I mean, in 1982, I guess it was, had the courage to stand up and say, this is it, it's finished, it stops. And he used a few sort of ruses to, he pretended to be targeting base money, because then he could say, well, if the interest rates went up, it was nothing to do with me. Right? So it was a kind of political ruse to do what he knew he had to do that would be politically very, very difficult. And, and he succeeded. And against that backdrop, a number of countries brought in explicit inflation targeting frameworks. I don't know if I'm pleased to say or not pleased to say, but New Zealand did it first, I think, in 1999, and Canada was 3 months later. And we had people from the Bank of England coming to visit us to ask questions about how you would go about doing whatever. And of course, the thing spread out to many countries in the advanced markets, although not the biggest ones. It's interesting to keep in mind. And now, of course, the creed, I mean, it's a bit like the gospel, okay? The creed is being spread out by the IMF and the World Bank and others to all of these emerging countries. So it's very, very widespread now. And the question, I guess, is why the framework has proved so popular. I think one of the reasons is that nothing succeeds like success. And this phrase, the great moderation, tells it all. So central bankers decided they were going to bring inflation down. And whether they had explicit targets or implicit targets, wonderful things started to happen. The great moderation. So through the 1980s and then really through the 1990s and straight through up until 2007, in many countries in the advanced economies, and particularly in the US and probably in the UK too, real growth was fast and not volatile. Recessions were very, very short. Inflation went to a very low level and stayed very, very stable. And this is where this phrase, the great moderation, came from. So nothing succeeds like success. And the central bankers, of course, were more than pleased to tell everybody that everything was getting better because they had said what they were going to do, reduce inflation. They did it, and it produced the goods. Now, the second bullet refers to something that everybody was conscious of, which is even though the real economy seemed to be more stable, the financial economy seemed to be having more and more problems. Okay, so you may remember we had the Japanese crisis, we had the Nordic crisis, we had the Mexican crisis, we had the Southeast Asian crisis, the LTCM, and the sort of list went on and on. But the attitude of the people that believed this sort of stuff was that it was only teeth in trouble. That, you know, we had new instruments and people had trouble getting used to them and they were doing things in different ways. But when they got used to it, everything would be fine. So the real side was fine and the financial side would be fine. And the last reason, I think, was that the underlying analytical model was, as I put it, simple, coherent, and supported with central bank accountability. And all of those things were good. Okay, I'm not trying to take away at all from the advantages of this thing. It's a very simple kind of analytical model, essentially demand-based, that if you had a positive demand side, a positive gap between demand and supply, you'd get inflation or accelerating inflation. And then if it was in the opposite direction, well, you would get a slowdown in the economy and inflation would slow too much. So you just manipulated the demand side and everything would be fine. And it was coherent because when you leaned against excessive growth, you also leaned against excessive inflation. It's coherent. And it was very simple for the central banks. They had one simple thing to do, and they did it. And they could be held accountable for it. So all of this stuff, I think, accounts for why the thing was so popular. But then the doubts started to creep in. As I say, we at the Bank of Canada, we almost started this thing back in 1991. And I remember the first of the doubts was the question about whether the costs of inflation might have been overestimated. And the way that this thing emerged, excuse me, I've been talking since about 7 o'clock this morning. There's always so many people to talk to in London. Could the cost of inflation have been overestimated? The worry really was on the supply side. So we observed some of these supply side shocks, tax increases. In Canada, we were trying to bring in a VAT. It was going to push up prices. Oh, thank you. It was going to push up prices. And as we started thinking, well, should we lean against that? Is that not inflation? We said, well, no, it's not actually. It's a price level shift. Okay, so we can live with it as long as it doesn't feed back into the wage price spiral. And that, in a certain sense, was the beginnings of the thoughtfulness about maybe some shortcomings. And the second one was the issue of whether the cost of deflation might have been overestimated. And this is bringing us closer to the question of what's gone wrong. You may remember Ben Bernanke's speech in 2001, when he said what to do if it happens here. And what he meant by that was deflation. And of course, the attitude that I think the Fed has had towards deflation, shaped really by the 1930s, which is not at all surprising, is that all deflations are terrible things. and that when prices go down, you have a real problem. But when you sort of think about it, and think about it against the background, really, what's happened over the course of the last 10 years, maybe when you get positive supply-side shocks, big ones coming in from places like China and new car factories in Slovakia and whatever, maybe those positive supply-side shocks are driving down prices, okay? And that maybe that's okay too. That because prices have gone down in the context of positive productivity shocks, okay, or positive terms of trade shocks, it doesn't mean that profits are going down, okay? And it doesn't mean that debt becomes less supportable as it would in a true debt deflation like the 1930s. So people started sort of thinking about that a little bit. Maybe there's not just a demand side to the economy, maybe there's a supply side that we have to think about a bit more seriously. And then I think there were some lessons from what I call the history of economic thought. Some people, at least, starting to think in terms of whether there were some insights, particularly from people like the Austrians and Heinsky. And I happen to believe that a lot of the stuff, okay, a lot of the stuff that you read in sort of Austrian theory is, well, if not incomprehensible, certainly difficult to understand. But the one thing that is there is the idea of credit driving real spending patterns and people making mistakes, what the Austrians refer to as malinvestment, with supply side implications. So they're starting to think about, well, maybe there's something in that too, you know. And then lastly, I'll mention the name here, Minsky. And I don't know whether any or all of you are familiar with Minsky. But Minsky's view, and again, think back to the Great Moderation, Minsky's view was that stability breeds instability. So that bankers start off in the first instance making loans that are self-liquidating. You know, it's a loan for something that you're making enough profit, you can pay the interest and you can pay the principal. And then the second stage is, well, I can pay the interest, but I can't pay the principal. And then the third stage is, I need another loan to pay the interest. Okay? And Minsky felt that it went inexorably from the first to the third. That as you got more and more confident, context, think again, the Great Moderation, everything is great. People just inexorably just go for it. And at the end of the day, what you're doing is you're running a Ponzi scheme. And like all Ponzi schemes, it will collapse. And I'll talk about that in just a second. But anyway, sort of thinking about the theory of, does inflation targeting or short-term inflation targeting all hang together? And then I think there were some apprehensions arising from the facts. Anybody who was prepared to read history realized that there have been all sorts of crises of various sorts in the past. Just go back and read Kindleberger, or, you know, Manias, Panics and Crashes. Some of the recent stuff that's been coming out, which is just terrific, from Ken Rogoff and Carmen Reinhardt and Alan Taylor, and you know, people are now actually capable of getting long data series, cobbling them together and using the computers to see patterns. But the basic message is a very simple one. If you read history, there was a huge crisis in 1825, there was another one in 1874, all sorts of minor ones, then there was 1921, there was Japan, there was Southeast Asia, right? Like, it's not as if these things came out of nowhere. We've had these things from time immemorial. And this is not inconsequential. When you go back and you look at that history and think about inflation targeting is going to keep us out of, you know, inflation under control is going to keep us out of all trouble. All of these countries had had these really, really big crises. There was never any inflation preceding them. Okay, there was no inflation in Japan in the 1990s. There was no inflation in the 1920s in the US. There was actually moderate deflation. I think the average inflation rate in Southeast Asia was 3-4%. Okay? So they all came without preceding inflation. And when you go back and look at it, they all came out of the blue. Okay? So the people that were living in the bubble basically just couldn't see it coming. And one of the loveliest lines that I know about this is from, it's in Skidelsky's Life of Keynes in the second volume. And there's a quote in there from Sir Josiah Stamp, and he talked about the Great Recession in Britain of 1921 after the First World War. And the line that he used was, "It was the failure of an anticipated inflation to materialize." It was exactly the feeling you get when you go up the stairs in the dark and you put your foot on the top stair that isn't there. And that's sort of the way it is when you go back and you look at it. When you're inside it and it's all building up and you ought to see it coming, but you don't, and you put your foot on the top step that isn't there. Well, this one ended in exactly the same way, right? The Great Moderation was sort of over from, you know, it was the Great Moderation on the 7th of August, and then BNP sort of closed off those 3 funds, and all of a sudden it was a different world, right? And the interbank markets, it was a different world. It just stopped bang like that. And I guess the point that worries me, and I'll be getting on to the, you know, some of the specific explanations of what went wrong here. But it is this surprise, which I think is based really in a faulty analytical framework, okay? The failure to recognize how these bubbles build up and materialize and burst, that led to not just the surprise at the end of the Great Moderation, but when you think about it, it has been constant surprise from start to finish. Remember Ben Bernanke right at the beginning of this thing? He said 50 billion. 50 billion confined to subprime. And then, of course, it became apparent that it was a much broader problem. It's a liquidity problem. It's a liquidity problem, and we can handle it. And then, as we move further and further, it's a solvency problem. Okay? It's a solvency problem. And now we've got a problem here. But it's confined to the financial sector. Okay, it's not going to touch the real sector. And then a year later, okay, really after the fall of Lehman's, then the real side collapsed. Remember in the 3rd quarter? And what's that great line? Even an economist, when he sees something happen, will admit it is possible. Well, this is sort of where we're at. Okay, it took them until the 3rd quarter of 2008 to admit that it's possible, and now we know where we are. And it's not over yet. Okay, it's not over yet, because I think there's something that's still not in the public consciousness here, and that is this supply side thing. We have got we have got some very significant adjustment problems on the supply side. And the marvel of capitalism is that the supply side really does respond to the demand side. You know, the market gives people what they want. The only problem is that now that they've done that, the market no longer wants it. And the 2 big things that I note, we can come back to it later on because start talking about policy, is a lot of industries are too big. Okay? Financial industry is too big. Car industry is too big. Shipping industry is too big. Wholesale distribution is too big. Container ships. Okay? Steel, aluminum, goes on and on and on. There's a lot of industries that have grown too big. And perhaps even more important, in terms of supply side adjustment, we've now got all of Asia geared up to produce stuff that people in the UK and the US and other places can no longer afford to buy. Okay, we have a huge intertemporal misallocation problem. And that is going to have to be dealt with over time. And in the period of time during which all of these supply adjustments are going to be taking place, you're going to see a significant increase in, call it what you will, frictional or structural unemployment. That's just, I think that's just reality. So, surprise from start to finish. And as I say, I think for a lot of people, there's further surprises coming down the road. Now, causes of our current difficulties. And this has got some political implications as well. I think there's 2 schools of thought that need to be taken into account. Most of the emphasis has been put on what I call here the comforting school of what is different. And what I mean by that is that we have had in the course of this last upswing widespread use of all sorts of new techniques and new instruments, right? And I'm thinking about things like structured instruments, CDOs, the question of originate to distribute, the expanded role of the rating agencies, off-balance sheet, sieves, conduits. Is all new stuff. It's very comforting for some people to put the focus on that. Okay, and it's very comforting because they fall back, and this is everybody within the banks, and it includes the supervisors, and it includes the central banks. Okay, it's very comforting because what you can say is this was all brand new. Okay, I have no idea that there would be these kinds of externalities associated with these kinds of new instruments. It beats me, huh? But you couldn't have expected me to see it. Comforting. And you hear a lot of that. The other side of it, too, is that it gives people something very specific to blame, okay? And where this is crystallizing at the moment, the sort of the school of what is different, I'm not sure that really is different, is the greed of bankers who must be punished, okay? And it's very nice to have a focus, okay? Very comforting for the public to have a focus, people you can go after. Well, there's a lot of truth in it, okay? My only hesitation when talking about the school of what is different is saying the bankers were greedy, because the bankers are always greedy. That's what they're paid for. But this is the second thing. It's the less comforting school of what is the same. And that brings you back to the history. Okay, it brings you back to the history. The school of what is the same is, we've had a credit bubble. Okay? It started off as rational exuberance. It morphed in like a Minsky-like thing. It morphed into something that was irrationally exuberant. And at the end, it collapsed. Okay? And we've seen it all before. We've seen it many times before in history. And you missed it. All of you. 10 layers of governance within the banks, the outside audit, the rating agencies, the supervisors, etc. You all missed it. Now that's not very comforting. Okay? So some people are prepared to talk about it. But I still feel central banks as a group. Alan Greenspan just came out with a piece, apparently, I haven't read it yet, 46 pages, basically saying it wasn't my fault. Ben Bernanke gave that presentation to the American Economic Association. It's all regulatory. Okay, so there's some people out there who are still saying it's, okay? And anyway, in terms of the process, all I would say with respect to this last cycle, just think about the period of time. I mean, if you want to limit it to that, from 2003 onwards, and you look at every asset price you can think of, every credit spread, measures of volatility, everything was moving in the same direction, basically saying the risks are down and the world is a great place and go for it. Okay? And it ended in, I don't know, is it Eliot? That's how the world ends, not with a bang, but a whimper. In the summer of 2007, it could have been either, okay? If the underlying problem is too much credit, I think you don't have to be a monetarist to say this could wind up in inflation. And you may remember that in the summer of 2007, a lot of us were very worried about inflation, you know, energy prices, food prices, whatever. But at the same time, beneath the surface, all of these imbalances, asset prices that were too high, spending patterns that were, with respect, crazy. You know, zero household savings rates in the UK, the US, Canada, Sweden, okay? Investment ratios of 50% of GDP in China. There was a lot of very odd stuff going on, okay? All of these imbalances. And at the end, of course, it all came unstuck. And the tipping point, and it is a tipping point, is often referred to as the Minsky moment. You know, this is when the bankers wake up one morning and they sort of, suddenly they recognize how imprudent they've been, or a single banker recognizes how imprudent he's been, and he says, oh, Jesus, I know I've been imprudent, but that guy across the street, he's been even more imprudent than me. This is a natural tendency, right? And the minute that that happens, it stops. Because nobody is prepared to lend to the other guy. And it looks like a liquidity problem. And that's how it was interpreted in 2007 and after Lehman went. But it's much deeper than that. And if people had been using this different kind of analytical framework, sort of drawing on the Austrians, drawing on history, drawing on Minsky, they would have seen it as it being a much more serious thing than they did. And they would have been much less surprised by the relentless progress of this damn thing over the course of the last 3 years. And I call it a Wile E. Coyote moment. You know, Wile E. Coyote, he's the one that chases the bird in the comic strips. And he's always running off a cliff, and he's running and he's going in a straight line, and then he looks down, and the minute he looks down, he's gone, okay? Central point to remember is Wile E. Coyote doesn't fall because he looked down. He fell because he just ran off a cliff. This is the way you have to think about these kinds of things. I'll be very brief on this because I'm going on too long already. We're in a bad place, okay? Having gone through this huge bubble and bust. Personally, I think we're in a particularly bad place because this thing we're going through now is the culmination of about 6 or 7 truncated busts that should have happened much earlier. But every time something bad did happen, in 1987, in 1991, in 1997, in 98, and 2001 to 3, you had this massive monetary and fiscal response to damp the whole thing down, okay? So that the sort of the purging and the unwinding and the correction of the imbalances that should have happened didn't happen. And so we're sitting here now at the end of 20 years of essentially having the wrong policy framework, I think. And so we shouldn't be at all surprised that we're in a bad place because it's taken a long time to get here and it's not a good place to be. What I wanted to go on about just a bit was, and I'm sorry to say this, but in a sense it gets worse. Okay? It gets worse. And it gets worse because the macro instruments that we're used to using in a certain sense, lose their efficacy over time. And in addition, headwind kind of problems are built up, the accumulation of debt, okay, which I know that I'm very concerned about here at the fiscal level and the household level in the UK, that you wind up exacerbating medium term those particular problems. So the use of the sort of these kinds of policies, one, they might not work, and two, if they do work, they may come with some costs that you won't be so happy to see. Monetary policy, will it work? There's been a big debate about what I call the lean versus clean debate, and I've got a paper out on that. Should you lean against the credit bubble, which is what I would recommend, or should you just clean up afterwards? And the Fed has always said you can clean up afterwards. Alan Greenspan, Ben Bernanke, that's what they believe, okay? And they say, well, the econometric models they all say that. And my response is, I don't think the econometric models are very useful. And we can go into all sorts of reasons for that. Charles Goodhart actually was they're talking about DSG models. This is the latest sort of fashion, dynamic, stochastic, general equilibrium models. But they're made so simple, so many assumptions are imposed upon them, that you take out all the stuff that's, what's the word, important. Charles Goodhart at a conference at the Bank of England said, quote unquote, there is nothing in these models that is of the slightest interest to a central banker. So that was nice. Must the future resemble the past? See, the Fed's response would be, we've leaned against all these other downturns. It's always worked. What's your problem? But my point would be, logically, it worked in the past by inducing people to take on more debts and still more imbalances. And the logic of it tells you that in the end, it won't work at all. Even if it has worked in the past. I mean, this is Taleb kind of stuff. You know, we're talking here about highly discrete distribution, like life. You know, it goes on for a long time and then it stops. Well, must the future resemble the past? The answer is no. And the third argument that the Fed uses is that the 1930s and the 1990s were policy mistakes. And they repeat that over and over again. It's got nothing to do with the imbalances that happened beforehand, okay, during the credit upswing. It's all to do with we made policy mistakes. And their line is, we'll never do that again. Simple enough, we'll just clean up. But as we know, I mean, in fact, I don't think I need to say this. All you need to do is read the Financial Times every day. Is cleaning up easy? No. Okay, we're 3 years into it now. Okay, is cleaning up easy? We've thrown the book at it. And will quantitative easing work? Well, it hasn't worked to date. Maybe it will, I don't know. I'll come back to that briefly in a minute. The fiscal thing is another one that, Multipliers. When I was a graduate student, I was taught that multipliers were big. I mean, it was good Keynesian economics, okay? And then Milton Friedman came along, and Milton Friedman said, well, don't forget about the feedback effects on the monetary side. The interest rates will be higher, okay? So the multipliers are not big, they're small. And then another group of people came along, the Ricardian equivalence people, and they said, well, people are not stupid. If you're going to cut taxes today, they know that you'll have to raise taxes tomorrow. So they'll compensate by saving more today. So nothing happens. And then a bunch of other people came along and said, don't forget that raising taxes has welfare costs. So longer term, the multipliers are negative. And then along came Larry Summers, and all of a sudden the multipliers are big again. Now, where did that come from? So there's some real issues here, and I won't go into it, but timely. The last 20 years, we all believed it was impossible to have timely fiscal policy. Temporary? 20 years ago, we all believed it had to be a permanent increase in income before anything happened. So I have the feeling that there's a lot of sort of theory being made up as we go along by the people who want to believe what they want to believe. Negative financial market reactions. Well, Hungary, Ireland, who else have we got? The Nordics a decade ago. There are real worries here that you will in fact run up against big interest rate increases, and it will make things worse, not better. And of course, currency crisis, you don't need to say much about that. And the last thing, and I think it's worth saying a few words about this, that if you get yourself into a situation where, you know, in this boom-bust thing, where the bust is, you got this huge buildup of debt, okay? Credit expansion, buildup of debt during the expansion. And now we've got the bust, and the headwinds of debt are making things worse. Now, one thing that you could do is you could say, let's just go right to the source, and let's just cut the debts, okay? Measures to help the household sector. Just cut the debts. But there's a problem, because when people used to cut debts in the past, I mean, I think in terms of my career, somebody like Bill Rhodes, okay? 10 banks have lent very heavily to Argentina. Argentina's not going to pay back, okay? Bill Rhodes would get these guys in a room, almost invariably guys, get these guys in a room and say, do you want 50 cents or nothing? Is it Eddie Izzard who does this routine? Do you want cake or death? Like the old Monty Python thing, right? Do you want cake or death? I'll take the cake, please. Well, people would say to Bill Rhodes, I'll take the 50 cents, and they'd grumble, but then they'd go away and the deal was done. Okay? And everybody would benefit in the sense that the Argentinians could continue and the banks could still continue, and everybody felt poor, but that's life, right? But we can't do that anymore because they've got, I don't know, 3-4 million sort of new foreclosures every year in the United States. I don't know what it's like. I think it's different here in the UK, but in the US you've got so many foreclosures. They're not set up to sort of to do deals with individual people. They're trying, but it's very, very hard. A lot of the mortgages are encumbered with second mortgages, the so-called silent seconds, okay, interfering with the process. A lot of the mortgages are bundled up into CDOs, and they actually have got bonds that have been issued against them that specifically say the stuff can't be restructured. So we got a problem. Measures to help the financial sector is a huge problem. We all know what's happened in the UK, very similar in the United States. The problem is that, in my judgment, it's been a half-done job. I think we're going slowly down the Japanese route, which is not really dealing with it and hoping you'll sort of grow your way out of it, as opposed to the Nordic route. It took them a bit of time, but at least when they recognized what was happening, bang, bang, you know. So I'm not sure that's going to happen. And lastly, what you see in the continent, of course, in particular, is these structural policies, where people are trying to preserve either wages or jobs. And it can work for a while. But it can't, if there is a fundamental problem of a sector ought to be smaller, trying to prevent that from happening by sort of a generalized increase in income associated with maintained wages or jobs when at the same time you're cutting out the profits and the lifeblood of the companies, it's not going to work. I mean, Hoover and Roosevelt did this in the 1930s. Both of them stomped the country to tell the corporations to keep up wages, and profits collapsed, and so did investment. So this, again, is a kind of Austrian kind of thinking about, you've got to think about the supply side implications of what you're doing. And let me just say, and I won't go into the individual things, but you can tell a story about each one of these policies too having bad implications over time. And on the monetary policy side, the first thing that I worry about is it's going to create yet another bubble. We've done what we've done. It's exactly the same, except more so, as we did in all the previous crises. You lower interest rates to stoke up the economy again. It creates another bubble that in the end just makes the next one worse. And I think we're seeing this now in Southeast Asia. Hopefully it won't be all that bad, I don't know, but I think there are reasons to be concerned about what is happening elsewhere. So we're seeing the bubble, we're just seeing it in a different place. But it is a byproduct of very, very easy global monetary conditions. And on the fiscal side, debts are getting bigger and bigger. Interest rates are starting to back up. We have a medium-term problem. And on the structural side, well, a lot of the stuff feeds back into the fiscal, so we have a problem again. And of course, a lot of the structural stuff that's being done is specifically designed to slow down the structural adjustments that ought to take place. And I'm thinking most explicitly about the car industry. You know, the number of people, the number of countries that are putting huge sums of money into part-time working, etc., in the car industry, and the industry is too big. So we're looking reality in the face and we're pretending it's not there. So all of these sort of policies, I worry very much about both their efficacy and their longer run implications. So my point is, and this is leading up to what I want to talk about here. My point is, we've gotten ourselves into a very bad place. And beyond that, it's not at all obvious how we're going to get out of this. Okay, but I can talk about this later in the question period. That's not really what I came to talk about. So it's an especially bad place. And we have a political window of opportunity, because things are bad, to start thinking about, can we do something today while people still remember, to try to prevent this from happening again. And this is really what I want to talk about. Do we need a new domestic framework? And I'm going to distinguish between the domestic and the international. I think it's important. Do we need a new domestic framework for macro financial stability? My first point is that price stability as such, at least near-term price stability, is obviously not enough to give you macroeconomic stability, right? We're in the middle of this crisis. It's gone on for 3 years. It was preceded more or less by price stability everywhere, and it's not enough. And so the conclusion, I guess, is that you've got to resist these credit booms. That's my conclusion anyway. That you need a monetary policy framework and a regulatory policy framework that incorporates this possibility of bad things happening right at the beginning and tries to, again, in sort of Western jargon, to head them off at the pass. And I think that's important. And we should, at the same time, too, I want to elaborate, we should be preparing for busts as well. Because even if you had a framework for macro financial stability that would damp down the credit booms and at the same time make the downturn less severe, these bad things are going to happen. I mean, of this I'm convinced. There's something in human nature that's hardwired that leads to this kind of stuff. Bad things will happen, and you should be prepared for it. But as you know, when I sort of say, when the crisis struck, did you have adequate deposit insurance? Did you have adequate memoranda of understanding between your domestic authorities? Did you have adequate legislation for winding down insolvent financial institutions? Did you have international burden sharing to determine how you deal with international institutions? Did you know what the counterparty exposures were to the big banks, to other big banks? The answer to all those questions is no, here in the UK. And the answer to all of those questions is no. And so if you think it was bad here, and this is still an enormously sophisticated place relative to many other countries, you can imagine what the situation is like elsewhere. So you have to prepare for the busts as well. One thing, though, I do want to make clear here is that if price stability is not enough, financial stability is not enough either. I hear a lot of people sort of emoting almost the idea that if we could just get the financial system fixed up and prepared to lend money again, then everything will be fine, okay? That if we had financial stability, it would be enough. And my point would be, this is not true. Okay? The problem of indebtedness is not just within the banks that are overly leveraged, okay? We've got to try to get them healthier. The problem is also elsewhere, okay? And this is the sort of the fundamental, I guess, Austrian insight, is that there are people, non-banks, who have borrowed from the banks and have used the money unwisely. And as long as they're suffering from those headwinds of debt and assets that are not providing the return that they should to service the debt, we have headwinds. And you can fix up the banks, and it's very important to fix up the banks. But if all of that other stuff is still out there, you really still have a problem. So, I think what you need, and I've sort of coined this word macro-financial, okay? Which is a macro-financial approach recognizes these interactions between the real side and the financial side, and says essentially it's a macro problem. And the job of whoever it is in charge is to try to make sure that really bad things don't happen. And that's got institutional implications that I know people are talking about. I think what it means is that the people best suited to deal with macro problems should be put in charge of macro problems. And what that means for me is the banking. And I want to be very clear here now. I'm talking macro-prudential as opposed to micro-prudential, okay, which is another whole kettle of fish, okay, which is a kind of bottom-up, institution by institution. I'm talking about the systemic overview about whether the whole economy is getting into this kind of credit-driven problem. I think it's got institutional implications. It may be different institutional implications. It may come to different answers in different places. But I think somewhere the people that think about macroeconomic issues, this is not a regulatory issue is what I'm saying. It's a macroeconomic issue. And that's got institutional implications. And I would say too, and I'm sorry to say it, but it's also got potential political implications as well. And the reason I say that is one way in which you avoid really bad outcomes, okay, which I think is what we see now, the byproduct of not allowing little recessions over many, many years. What it really means is you should be more willing to allow little recessions and not try to clean them up completely each time that they happen. Well, as we were saying in an earlier meeting, go sell that one politically, okay, that we've got a downturn and we're not going to pull out all the stops to stop it from happening. This is going to be a tough political sell. But it doesn't mean that we... So, what would such a framework look like? First thing, and I've already mentioned it, is you'd want to focus on the interactions. It's a question of systemic issues, if you want to put it that way. And it's the interaction of the real and the financial. And within the financial, it's a question of the systemic issues. So when you're thinking about the financial system, you wouldn't be thinking about individual institutions. You've got to have a systemic view that says, what if all of these institutions that look healthy get hit by the same kind of shocks, react in the same kind of fashion, unload the same kind of assets? What happens? And what happens is that what looks like really healthy to start with starts to look very unhealthy very fast. But there's experience with this kind of stuff, but that's what you have to look at. Both the monetary and regulatory measures should be used more symmetrically. On the monetary side, I spoke earlier about the lean versus clean thing. In the States in particular, and I think many, many others did this too, there was never leaning against the upside, okay? There was just leaning against the downside. And so, of course, the interest rates, if they don't go up, but they always go down, it's not rocket science, right? It's arithmetic. To figure that out over a period of time, you're just going to ratchet down to zero, which is precisely where we are. So I think monetary policy has got to be used in a much more symmetrical way. Regulatory measures as well. Regulatory measures are even worse. I mean, I don't know whether you appreciate that. But the regulatory system doesn't really lean against the upswing of the okay? And it comes down like a ton of bricks in the bust, because then the risks have already materialized, the provisions for losses, you know, have to go up. This is making things worse. So there's a real problem on that side too. So I think we need more symmetry. I spoke earlier about inflation targeting, and I should have been more specific. Inflation targeting, as it's currently practiced in most countries, basically says keep inflation under control over, let's say, a 2-year period, 2-year time horizon. It's relatively near term. And I think one way that you can square the circle of still putting it in terms of price stability, but being worried about these credit expansions and busts, is you say, I'm actually worried about price stability over a significantly longer horizon, 4 or 5 years. A horizon long enough to be worried about these booms and busts. Because if the bust happens against the background of continuing low inflation, it seems to me almost inevitable that we'll wind up in deflation. And deflation is not price stability either. Eh? So that's one way you can square the circle, is simply extend the horizon and think about it in these rather different terms. And on the regulatory side, and this is all consistent with Basel III, it seems to me. This is my second last slide, I'm almost finished. On the regulatory side, and I'm just talking now about the credit, boom, bust, cyclical stuff, I think we need significantly stronger counter-cyclical capital requirements. And there's ways in which this can be done. This is not an insurmountable thing to do. And ideally, you might even be able to do it on a rules-based basis, so that people, as the boom was moving on, the capital requirements would get ever more onerous. And the banks might try to complain, but the point is it would just be a rule. There would be no discretionary sort of talking about it. It would just happen. So you can talk until you're blue in the face. I'm sorry, this is just what happens. I don't think this is going to happen, actually, a fully rules-based thing, but if there were more rule rather than discretion, I would like it, because I think the problem with discretion is that the supervisors won't do it. The same sort of way as the central bankers will find it hard to pull the plug too. And we need surcharges for systemically important institutions, and we can come back to that. And lastly, this issue of credible resolution schemes. Because one of the big problems at the moment is with all this sort of, you know, these successive cycles, and every time in the cycle, the authorities come in and sort of boost everything all up again, you're basically bailing everybody out. You know, you're creating moral hazard. Everybody knows it, and they go for it. And I think what you need to have is credible resolution schemes so that the shareholders know, the management knows, the bondholders know, we're going to take a really big hit. And we're not there yet. We're not there. And in part, it may be because of this last slide. If I think the sort of broad principles, this is what I espouse, and I'm sure it won't come to pass, the broad principles for a better domestic macro financial stability framework are in place. At the international level, it starts to get really messy. And that's why I've sort of put on this slide, you know, but. On the regulatory side, I'll start with that. We've got this Basel III process. And I mean, I've read the documents. I'm sure many here have read the documents. Came out at the end of December. A lot of extremely sensible stuff in there. There's going to be a lot of horse trading about how stuff should be done, but it's a lot of very sensible stuff there. They're still a bit too fuzzy for my liking on the counter-cyclical stuff that I think is central, but never mind, they're getting there. But too many local initiatives. I don't know about you, but we do live in this very, very highly globalized world. And if we're going to have everybody, particularly the big players like the UK and the US, have their own particular schemes about what they're going to do, you know, the levies on deposits and insurance funds for failure, and what else have we got? All the taxes, you know, and bonuses, and the Volcker plan, and the list goes on and on. And a lot of these things are very good in themselves. But if we live in a globalized system, we can't, you know, keep going down all these different paths. So my advice would be, let's try to focus on Basel III. The difficulty at the moment, I suspect, and I just came back from the US, there's a very strong sense that there's so much political uncertainty in the United States that the people that represent the United States don't actually know what they represent. And the US may not be the big hegemon in the way that it was in the past, but it's still very, very important. And if they're not prepared to stand up to the plate and go into the negotiations, not much is going to happen. So this is a problem. On the sort of domestic monetary policy, I put a lot of emphasis on monetary policy should lean against the credit bubble. Here the complication is sort of deeply macro, that sort of what you can do with monetary policy depends on your exchange rate regime, what you've decided to do with your exchange rate regime. And all one can say, again, just have to read the Financial Times and see what Mr. Wen had to say and others about exchange rates. It looks on the surface, at least, as if there's no agreement that exchange rates in Asia should go up because they're running the biggest current account surpluses in the world, bar Germany. There's no agreement on the way forward. And in a certain sense, against the backdrop of what I've said, in a sense it's not surprising because, and I'm finished with this now, there are problems with both sets of exchange rate systems. So if you've got a fixed exchange rate system, as the Chinese effectively do, let's say, against the United States dollar, what they're doing implicitly is they're importing all of the inflationary imbalance pressures from the United States into China. And we're starting to, otherwise put, the monetary policy of the Fed is not the right policy for China. But it's the policy they've got because they've pegged the exchange rate. And the upshot of the whole thing is that I think the inflation, what you expect to find with massive credit expansion is the kind of thing we are starting, in fact, to see in China. Now, how bad it will get, I have absolutely no idea. But there are growing concerns, as you can see in the paper and elsewhere, that maybe the thing is finally starting to get out of hand. But there are problems with flexible exchange rates too. And this was made very clear to me at the OECD, and this is all in the public record now, the documents are all published, in the case of New Zealand. And the New Zealanders recognized that they had a real problem at home. And with credit bubble and asset prices and household indebtedness and whatever. And they really did try to lean against those pressures with higher interest rates. And the upshot was that the exchange rate went way up, which of course gave them even more problems on the current account side. And it attracted so much foreign capital that in fact the asset prices actually seemed for a time to accelerate as opposed to decelerate. Okay? Now this is not supposed to happen, because if you think about what they call the uncovered interest parity condition, New Zealanders raise their interest rates relative to everybody else, and everybody says, well, that differential is the measure of how much we expect the exchange rate to depreciate. And I'm not going to put my money into a currency that's too high and will depreciate. But the reality is that's not the way the world works. And this is another failure of the efficient markets hypothesis. Because once this momentum gets started and the exchange rate starts going up, you've seen this in many, many countries, then the money just starts pouring in because they figure it's going to go up even more. So they come in, they've got the carry because the interest rate is higher, they buy into assets that are appreciating, and the currency's going up. And you're trying to tell me this is not a good deal? So the upshot in the New Zealand case was that they really had trouble sort of making that work. So for small open economies, when I start thinking about this lean against the wind of credit, I have to admit, even though I've been a proponent of this for a long time, when you start thinking about those sorts of economies, I really do have to question my own sort of recommendations. And what makes me even, and maybe I finish this by sort of, as it were, going back to this slide. I say this is a problem, absence of understanding with respect to small open economies. But maybe the real problem is that in the modern world, we're all small open economies now. So where that leaves us, well, let's just leave it with that. So that's basically what I wanted to say this evening. I've spoken too long. Thank you.
very much for that. We've now got a short period where Bill's going to answer some questions. I think we'd prefer it if you could ask a question as opposed to just kind of holding the floor. That'd be appreciated. Try and keep to one question at a time. And so we'll get through as many of your questions as possible. But first, I think I'm going to take Chairman's prerogative and ask the first one. Now, Bill, you talk about leaning into the sort of the credit upswing. I mean, one of the central things I kind of always hear about with regard to this is that when you have an individual bubble that rises, say in the UK in the housing market, and you could well say that we had higher interest rates even back in 2001, 2002 for a long period to try and hold this back. But because it's such a broad measure, and you have to try and take into account all the different factors, how can we actually focus on individual bubbles and kind of be able to target these and try and restrain them individually without just raising interest rates in the whole situation?
One of the it's very easy to characterize what it is that some of us at the BIS were saying as being target asset prices, but there's a real difficulty with it, and it's a straw man kind of argument. I put it that way, because, and I've had this from the Fed, I don't know how many times. They say, what you're saying is target asset prices. Which asset price do you intend to target? You've got asset prices right, from houses to stamps. Which asset price? And of course, there's no answer to that, right? So you look stupid. And then they say, well, okay, you've chosen asset price. Well, how do you calculate the fundamental value? And how do you know the fundamental value and know when to lean against it? What's a bubble? Very hard. Then you look stupid. But our approach, I think, is really a much broader one. It's to say this is not an asset price problem. Asset prices are a symptom of an underlying problem of excessive monetary and credit growth. And this will manifest itself in various ways. And so you take things like, if you have a situation where credit growth is very fast, where the price of virtually all assets, and which is what we've just gone through, and we're literally all the way from houses to stamps, okay, say nothing but fine wine and antiques in between. They're all going up. We observe very strange patterns of spending behavior. Like I say, 0 household interest rates, 50% investment ratios in China. You put all of those things together and you know that there's a problem. And while the work is not very well advanced yet, it's reasonably well advanced to use these kinds of things in indicator models that basically calculate the probabilities, conditional on these things that you're observing, of problems building up on the basis of past history, both from your own country and from other countries. And you can do something about it, and you decide what it is that you're going to do. And another approach, I mean, I've heard people talk about is, it's not a million miles different from taking a Taylor kind of rule, which is now sort of pretty well established. So you're using the simple gap to guide whether you raise interest rates or not. It's not a million miles distant to say, well, don't just look at that, look at some other stuff as well. And there's a lot of work going on at the moment. But I do think it has to be thought of primarily as a sort of a broader macro issue. And it's not just an asset price issue.
Okay, thank you. If you could state your name and your affiliation as well, that would be really helpful. Yes, here at the front.
Tim Harper, Financial Times. You mentioned that you thought it would be a good idea for the macro-financial regulator to focus on systemic linkages and also credible resolution mechanism. And of course, those linkages are very complex, and the institutions that you might want to credibly resolve are also very complex. So it's going to be easier said than done. Do you have any advice as to how regulators might think about those problems?
Well, the first thing I think that they have to think about, and it goes back again almost to the question about sort of capital requirements. Imposing extra capital requirements on systemically important institutions. Who are they? What are they? And the first point to note is it's not just size. It's a combination of three things. Sorry, it's a little bit like it's not just asset prices, it's actually more complicated than that. But not like really complicated. There is the question of size, there is the question of complexity, and there is the question of concentration. But some financial institutions may not be all that big, but there's certain markets, where they're on 90% of one side of a trade, and if they're gone, the market's gone. So there's these three things. And I'd recommend to you an article that was in the last BIS quarterly bulletin. I had nothing to do with it. It's probably why it's higher quality than it was before. But it's Borio, Tereshev, and Tatsaronis. But Borio was the first name. And they basically devised a method whereby you can look at these sort of, you can determine how much systemic risk an individual institution has on the basis of these measures of size, complexity, and concentration. And I won't say it's not the last word on it, but it's certainly an important step down the line. The complexity aspect of it is the one that you're on about, and that really is, I mean, it's a huge problem. And I think Paul Volcker's suggestion actually is actually designed to deal with that. And when he came up with this first thing about sort of no proprietary trading and no equity holdings and no hedge funds and whatever, my immediate reaction was, what's he on about? I mean, that was not the source of the problem. I mean, I think virtually everybody would say that. That was not the source of the problem. What are you on about? But when the guy, when he talks about it, and I was at a meeting in Berlin where he was there a while back, he's really trying to get at this thing. That one of the reasons why the regulators have done what they've done, okay, and why the governments have done what they've done, is that they're just so, given the complexity, they're completely uncertain. I mean, it's not even in the realm of risk anymore. They're completely uncertain about what the ramifications would be if we simply said, let it rip. And that's why they haven't done it. And what Volcker, I think, is sort of trying to get across is that if we could just somehow cut that complexity, it would make it much, much easier to get a viable resolution scheme. And we'd all be better off in consequence. So he's not really focusing on, this is the source of the problem. He's sort of focusing on, this is why we've not been able to get the proper resolution. So.
Next one. Yes, here in the brown. Sorry. Yes, you there. Yes.
Well, I'm Samuel Britton. I have two questions, and I'm only allowed one.
No.
Could I just say that if I'd known the quality of the audience before I came, I probably wouldn't have come.
That would have been a great pity, because you were one of the very few people who roughly called this crisis right, and were not bemused by the stability of consumer prices. But I still have a couple of doubts. One is that you were talking about too cheap money early in this century, but you didn't mention China until much later in your talk. Now, if I can give a slightly Keynesian perspective, there was an ex-ante saving surplus in the world coming. Well, China is a symbol, there was plenty of information in general. Now, if they were saving far more than they were investing, other people in a full employment world would have to do the opposite. And that is, I think, Bernanke gave that justification.
Yeah.
And how do you knock that down? And the second question, looking ahead, is I'm a bit worried by countercyclical automatic indicators of policies. And that is there really a cycle? Supposing, take this country, if we got up to 10% unemployment, would that mean that we were at the bottom of a sort of second leg of a depression, and that the countercyclical and that the regulatory rules would be revised down, would be eased, or would you say that we're perhaps in a new world and the natural rate of unemployment is very much higher? And one of the things that worried me since I've been in short trials is that looking at non-economists, looking at the charts of economists, I'm not sure that there is. You have variations. Economic growth does not in a straight line. But if there is no regular trade cycle, cyclical corrections are going to be very difficult.
Yeah.
Sorry.
Yeah, I think, I mean, both of these are very, very good points. On the first one, I guess my sense of it is, I found the whole thing when it first came out sort of too self-serving when Bernanke and the others were talking about it. And my immediate thought, and I sort of had this at the beginning of a paper I gave a couple of years ago, was when you think about the identity, you know, it's S minus I equals X minus M equals capital flows equals inside brackets S minus I star, X minus M star. Okay, there's all of these different factors in the identity to make it all add up. And all of these things are endogenous. Okay, they're all dependent on exchange rate movements and interest rates and everything else. And why one would want to focus on Asian S, which is what they did, the Americans. I mean, I think they still continue to do it and say that's the problem, as opposed to all of the incentives that were being given internally for massive reductions in household savings rates and over-indebtedness and the rest of it. I just think that everybody's sort of equally culpable here. Looking towards solutions, I mean, what is clear is that those countries, particularly in Asia, which have got very high personal savings rates, should get them down, and that other countries that have got very high levels of debt and low savings rates should get them up. And it's a mutual problem. But in the same sort of way as I think maybe 5 or 6 years ago, everybody sort of had an understanding about exchange rate movements. But there was a real resistance on the part of everybody to do what needed to be done. I don't see that the resistance has really gone away, and it sort of scares me a bit, because the Chinese are basically saying, at least insofar as exchange rates are concerned, that everything's fine, there's nothing to do, you know. And Germany, I think it was your colleague Martin who coined this, what was it? Germany? You know, it's sort of even within the European community that somehow surplus countries don't really have to do anything because somehow it was the market that gave them a big surplus. And I don't think that's the right way to look at it. So I think everybody in a sense is culpable here, and I think we know the policies that would be desirable, but I see big impediments to actually doing them, which worries me. And in the trade cycle thing, I mean, I agree with you, but I don't think that you need to, as it were, have a great deal of regularity. I think you have to have at least a sense of, a broad sense, you know the joke, I don't know much about art, but I know what I don't like. And you have this sense that somehow, that if, you know, you just draw a line through the sort of what's the word, through the structural part of it, and basically say that's the norm. But you do know in your heart of hearts that maybe it isn't. But it's a first approximation, and then I think you'd be talking in terms of, you know, when you get 2 standard deviations of normal variations, then the alarm bells start to go off. But I think my friend Claudio Borio wrote another piece about indicators and all this kind of stuff. And all I can remember about the title is that fuzzy measurement fits into it. And in a certain sense, we've got to be less ambitious here in terms of what it is that we're less ambitious. We've got to be less concerned about doing the job perfectly right. Again, back to Keynes, I think. So that we're going to do it roughly right. And we're not doing it roughly right at the moment. And this crisis indicates that fact.
Yes, question there in the middle.
Hi, good evening. Mary Chapman from Elliott. I wondered if I could ask you about a relatively local problem in the sense of Europe. We've seen some very serious imbalances developing in Europe, both private and more recently public sector debt. However, the root cause, it seems to me, and I'd be interested in your opinions on this, the root causes of this were not necessarily in errors of economics, but they were errors of politics, in the sense that the political framework overrode the economics. Now, I think you could also take that one step further and say that actually the political framework for what might broadly be called Washington consensus and whatever preceded it was also a political framework which actually led to where we are, and actually led to the fixed exchange rates of China, the trade surpluses there, and the reactions of that.
Yeah, within Europe, I must say that, of course, I'm not qualified to speak because I live in Switzerland. But within Europe, the thing that has struck me about this Greek thing is how political it all really is. And you may recall a few weeks back there were op-ed pages, sort of, I think, make it up, one on a Monday by Otmar Issing and one on a Wednesday by Tommaso Padoa-Schioppa. And both of these people are just enormously clever and I think reliable thinkers, and I like them a lot.
Right.
And they came down to completely opposite conclusions about what should be done with the Greeks. And they both started from the point that you did, that you got the cart before the horse here. In a certain sense, never should have done it, but we did it, and the founding fathers all knew that this would be, that eventually we'd get down, partway down the road and it might be difficult, but then we'd have to move on and do the other stuff, okay, which is making it more like an optimal currency area with fiscal transfers and all this kind of stuff. But the difference between these two guys was political, as far as I could tell, that basically what Tommaso was saying, the founding fathers always knew that we'd have a crisis. A crisis is an opportunity, seize the opportunity, set up a structure that will help the Greeks, conditionality, go for it. And now we've got a mechanism that we should have had from the beginning. And Otmar's response, again, completely political, is, well, you could do that, but as Brussels imposes its will, the conditionality will infuriate the Greeks, okay, against Brussels, and the bailout, whether it is or whether it isn't, will infuriate the Germans. So what's the point? You know, this is not the time to do it. But I was struck by it's all very political, and there is a widespread understanding that, or there seems to be, or agreement that it ought to have been constructed in a different way, and that they want to construct it in a different way, but disagreement as to whether this is the time to do it.
We've got time for one more question. Jess there, and then we'll move on.
William King of the Observer. Bill.
I'm not going to repeat my speech, Bill.
No, I'm sorry, I apologise for, I've got a good reason why, sorry. I was determined to get here. First of all, I'd like to echo Sir Simon Britton's congratulations to you on it. You did, the Queen said she wasn't warned, but you warned her. Okay? You warned her. It was terrific stuff. And God knows what they tried to censor you, but you got it through the BIS report. But what I want to ask you, and you may have covered this, interesting you're having second thoughts about triggering asset bubbles and so on.
More broadly, leaning against
the leaning against. Okay, fine. Towards the end of his book, his last book, Major Recessions, Christopher Dow said that in the end you can't really trust policymakers to trigger. You know, in the end they're going to let the boom run. So therefore, why don't we go back to first principles and have old-fashioned credit controls, cash ratios, liquidity ratios, and so on. Now, forgive me if you cover that, but if not, what do you think of that?
No, I haven't. Well, in a certain sense, I mean, I didn't mention it in his presentation today, but when you start talking about monetary policy leaning against the wind, it isn't just interest rates that can be brought to bear. And again, the BIS, we've done 2 or 3 papers on this about people that have tried to use other things, which are back in a sense to all of the stuff that we gave up because we said we don't need this artificial quantitative interference because the market is efficient. And I mean, you know, when I worked at the Bank of England in the early 1970s, I mean, there you had, you know, higher purchase and down payment requirements and loan-to-value ratios and primary requirements, secondary requirements. You know, there's all sorts of things that you could throw at this if you wanted to. And they may be sort of things that you normally think about as regulatory instruments. Haircuts is another one, you know. All sorts of things that you could throw at it. But they wouldn't be used for traditional regulatory purposes. They would be used to try to damp down what was going on. Now, I also have to say, when you think about all of these things, whether it be the regulatory response or the monetary policy response, when you talk to a lot of people, the monetary people will tell you this is, using monetary policy is going to be really, really tough. So you better use regulatory policy, or at least regulatory instruments. And when you go and talk to the regulatory people, they say, oh, using regulatory instruments. Well, look at Spain. I mean, they had dynamic provisioning, right? Everybody says this is a great thing. Didn't prevent their bubble. Gave them more capital when the thing was over to manage the crisis better, but it didn't. So this is really sort of a tough one, and I haven't researched this in any sort of way. I just sort of think that if you've got a real problem, and you've got a number of instruments that you could use to try to minimize the magnitude of this problem, and it's a very, very costly problem, we're all seeing, that you just throw everything you've got at it, and hope that some combination of it will take the edge off it. And I also think too, and I'll throw this out maybe as the last point, I remember back in the early 1970s when everybody said that it was impossible to get inflation under control. That basically inflationary expectations were sticky, and that it would be impossible to ratchet them down, and that the short-run Phillips curve was very flat. So if you did want to gradually eat away at the expectations, it would take enormous increases in unemployment to do it. And both of those things proved to be false. And beyond that, and I will not go so far as to say the central bankers for a long period of time, or throughout the whole period, have sort of gained credibility and kept inflation low. But I do think in some countries at least, maybe Germany and Switzerland and some others, that the firm commitment of the central bank not to give in to the inflationary thing changed people's behavior. And I guess I would hope, although there's no, maybe there's academic work on this that I don't know about, what I would hope is that if there were a firm commitment to say these kinds of bubbles will not be tolerated, and we'll use all of the instruments that we've got to try to deal with it. And I forgot to mention fiscal policy could also be used. And the tax policies and all that stuff is just, you know, again, politically...
That went out of fashion.
that went out of fashion, but I mean, you know, cutting the deductibility of interest deductibility under certain circumstances. You can think of all sorts of different things that people can do, but politically, it's a man with a big mortgage. That you might in the limit, I hope, alter people's expectations of what is reasonable and induce them to start behaving in a more reasonable fashion. And that would get you back into what I think Axel Ian Ufgard calls the corridor of stability, you know, within which things work actually pretty well. But once you get beyond those, okay, then you get into these sort of interactive Keynesian mechanisms that drive you further and further away from equilibrium. So if you could think about changing people's behavior, and it's happened in the past, then you tell a happier story going forward than if you can't say that.
Thank you.
Bill, thank you very much indeed for coming to speak at Policy Exchange. I hope you've all found it illuminating this evening. I know I have. Thank you.